Hi, this is Kurt Kringles, Senior Credit Strategist with ING Investment Management. I would like to take a few minutes to share with you a brief update on the performance of the fixed income markets. Most fixed income sectors generally traded sideways in February and generated relatively flat excess returns. The emerging markets were an exception and exhibited mild weakness. In recent years, a rising equity market has been correlated with tighter spreads, but that has not been the case so far this year. Within the U.S. corporate market, the breakdown in this relationship may have its roots in the diverging interests of equity holders and bondholders. The year-to-date excess return pattern for the corporate market may foreshadow the excess return pattern for the year. The financial and utility industries have posted very strong excess returns so far this year, while virtually all of the industrial subsectors have lagged the overall market. Aggressive shareholder-friendly actions or potential actions have negatively impacted issuers within the energy, technology, communications, and consumer non-cyclical industries. We may be entering an environment where investment in the financial and utility industries can offer investors a relative safe haven. These two industry categories have generated year-to-date excess returns in excess of 100 basis points, while excess returns in the industrial category have been roughly flat. The volume of shareholder-friendly activities has generally been rising since the end of the financial crisis. Our proxy for shareholder-friendly activities is measured as the sum of the dollar volume of M&A activity as reported by Bloomberg and the sum of the dividends and stock buybacks from a sample set of investment-grade corporate issuers. We have previously been dismissive of the threat to aggregate corporate credit quality from the rising volume of shareholder-friendly activities. We believe that cash flow was growing rapidly enough to offset the increased payouts to shareholders, and that relatively wide high-yield spreads and elevated macro uncertainties would likely serve as sufficient deterrents to aggressive releveraging of corporate balance sheets. However, spreads have tightened significantly during the last few years and macro uncertainties have eased, so current conditions are more enticing for companies to increase leverage. We are maintaining our neutral outlook on the corporate market based upon the concern that corporate management teams will increasingly succumb to shareholder pressures to increase balance sheet leverage. Historically, rising volumes of stock buybacks, dividends, and M&A activity have not been overly destructive to corporate fundamentals, as improved economic conditions have led to offsetting improvements in cash flow from higher earnings. However, we are currently in an environment where profit growth is decelerating and debt is rising faster than cash flow. This dynamic leaves corporate fundamentals more vulnerable. Our longer-term outlook is still constructive. Improved technical conditions, a change in valuations, and an inflection in profit growth are among the potential catalysts that could lead us to increase our risk profile again.